The global economic landscape is in a state of upheaval, with recent news indicating a shift in China's economic trajectory that could have far-reaching ramifications. This move comes at a time when the world economy is in a state of flux. China, which is now undergoing a substantial slowdown, is often referred to as the economic miracle and a powerhouse of growth. This has prompted discussions about the potential influence that China's slowdown could have on the economy of the rest of the globe. We need to look into the forces that are driving China's economic transition and how it might influence different stakeholders, including investors and consumers all over the world, in order to appreciate the complexities of this shift and the potential implications that it could have. Today, we will talk about China's economy just flipped and what it means for you. The comparative use of a magic trick. Contextualizing the development of China's economy using the metaphor of a magic trick is an interesting approach to think about it. China has seen a stunning shift over the course of the last 4.5 decades. What was once a society that focused mostly on agriculture has since evolved into a global manufacturing and economic powerhouse. This shift has been a significant driving force behind the expansion of the world's economy, with China serving as the epicenter of manufacturing. The success story that is China's economic expansion has been very profitable for investors from all over the world. On the other hand, similar to a magic trick, its growth may contain aspects of an illusion. China's sluggish economic growth. China's economic growth has been remarkably fast for many years, with annual rates exceeding 10–12%. However, recent reports show that this growth has slowed down. There's a concern about deflation in China, which is a situation where prices consistently decrease. While this might seem good, it's actually a sign of more significant problems in the economy. Deflation in China means that people are buying fewer things, leading to companies making fewer products and the economy becoming smaller. The growth rate in the first half of 2023 was 5.5%, which is low compared to China's past growth. Several reasons contribute to China's sluggish economic growth. Trade pressures. China holds a significant position in global trade due to its substantial exports, especially in the field of manufactured goods. This export-driven approach has played a pivotal role in China's economic growth. However, the country's reliance on exports makes it vulnerable to trade-related challenges. Trade tensions with other nations, often manifested as disagreements over tariffs or trade limitations, can have far-reaching consequences for China's industries that heavily depend on exports. These tensions can result in reduced demand for Chinese products in certain markets, leading to decreased revenue for companies and potential job losses. Moreover, shifts in consumer preferences in other countries can also impact China's export-oriented sectors. If consumers in other nations change their buying habits or prioritize products from different sources, it can directly affect the demand for Chinese goods. In addition, disruptions in global supply chains can have a domino effect on China's economic activity. Many industries rely on components or materials sourced from other countries, and any interruptions in the supply chain can lead to production delays or even halt manufacturing altogether. This, in turn, affects China's economic growth as production and exports decline due to supply chain disruptions. Structural challenges. China is transitioning its economy from one that is heavily reliant on manufacturing to one that emphasizes services, innovation, and technology. This shift is part of a broader effort to ensure more sustainable and balanced growth. However, such transitions are complex and can lead to temporary imbalances. Industries that were once robust might face challenges, and the new growth drivers might take time to fully establish themselves. Debt overhang. China's rapid economic growth over the years was fueled by substantial borrowing, both by the government and corporations. While debt can be a useful tool for growth, excessive levels of debt can become a burden. Repaying debt and interest can divert funds away from productive investments. Managing debt levels is crucial to maintaining economic stability while continuing to grow. Environmental concerns. China's rapid industrialization has come at the cost of environmental degradation. In recent years, there has been a growing emphasis on addressing environmental issues such as air and water pollution. This often involves stricter regulations on industries that contribute to pollution. While these efforts are necessary for long-term sustainability, they can impact economic growth in the short term, especially in sectors that rely on resource-intensive practices. Influence on the economy of the world. The fact that China is the world's second-largest economy means that the state of its economy has a significant bearing on the dynamics of the global economy as a whole. The expansion of the economy in China has always had a stimulative effect on the economy as a whole, which has been to the advantage of global investors and businesses. In contrast, a downturn in China has the potential to send shockwaves across markets around the world. One recent example of this is the recent drop in the stock market in the United States, which was triggered by a lower than expected growth report from China. This interconnection underscores the degree to which the economic stability of China is vital to the rest of the globe. The real estate conundrum. The current situation of China's real estate industry is one key aspect that is contributing significantly to the country's slowing economy. The real estate industry in China has been a driving force behind the country's overall economic expansion and is responsible for a sizable share of GDP. However, this has resulted in a crisis in the real estate market due to behaviors such as excessive borrowing, overbuilding, and speculation. Large-scale real estate developers such as Evergrande have been hit with significant financial difficulties, which has shaken the confidence of investors and raised concerns about a domino effect across the industry. The possibility of a collapse in China's real estate market might make China's already difficult economic situation even worse. Shifts in the demographic makeup. The demographic makeup of China is also contributing to the country's economic decline in recent years. China's massive and highly productive labor force has been a primary contributor to the country's economic expansion for many years. Nevertheless, a combination of a declining population of people of working age and rising unemployment rates among young people presents a considerable obstacle. An additional factor that influences the labor market is the migration of young people from rural to urban areas in search of better job possibilities. These fluctuations in population could result in a scarcity of labor, economic imbalances, and increased competition for the jobs that are currently accessible. Implications for investors around the world. Investors all across the world are feeling the repercussions of the economic downturn in China. It is possible that businesses with large operations in China, such as Apple, Starbucks, and Tesla, will see a reduction in their profitability as a result of lower demand and challenges posed by operations. Additionally, the possibility of economic instability in China could result in an outflow of capital from the country, which would have repercussions for a variety of industries and investments. The unpredictability brought on by these elements could result in greater market volatility, which would have an effect on the confidence of investors and their ability to make decisions. Trade relations and the capability of the economy. The rapidly shifting economic landscape raises questions about the trading relationship between the United States and China. As a result of the slowdown in China's economic growth, countries may become less reliant on China's industrial capabilities and start looking for new partners. While this could have benefits in the short term, it also has the potential to quicken the speed of automation. This is because businesses are constantly working to improve their competitiveness by cutting costs. This in turn might have an effect on job markets, which would deepen disputes over the advantages of more automation versus the importance of maintaining employment possibilities. The view from the shopper's perspective. A slowdown in China's economy could lead to higher prices for consumers as a result of disrupted supply networks and lower production. Inflationary pressures may occur from delays in the delivery of goods that were previously easily accessible or from a greater scarcity of those goods. On the other hand, there is a possibility that prices of commodities would fall, which may bring some respite because it may result in lower expenses for raw materials. When all of these elements are considered together, it is possible that consumers will see a mixed influence on their ability to buy things and their overall cost of living. China's economy has been a driving force of global prosperity for decades, having transformed from an agricultural culture into an economic superpower in that time. Nevertheless, the current economic slowdown in that region poses a number of complicated considerations regarding the ramifications for the rest of the world. There is the possibility of gaining benefits, such as a shift in manufacturing and lower commodity prices. But there is also the possibility of experiencing obstacles, such as disruptions in supply chains, potential crises in the real estate market, and changes in the global investment environment. As the globe navigates these changes, stakeholders, including investors and consumers, have a responsibility to closely watch events and adapt their plans to an ever-changing economic reality. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go.